For a long time, I believed my finances were safe. I wasn't careless with money. I had savings, insurance policies, and what I thought was a sensible financial structure. On paper, everything looked fine. Friends and family would probably say I was better prepared than most people. But one unexpected emergency quietly proved me wrong. Not with chaos or financial collapse. Instead, it revealed something more unsettling. Small delays, friction, and moments where money should have been available but wasn't. That experience changed how I think about financial safety, because financial safety isn't about how responsible you feel. It's about how your system behaves when life suddenly puts pressure on it. Most people eventually reach a stage where they mentally check the safe box in their finances. Some savings, some insurance, a steady income, maybe even a few investments. At that point, financial safety feels handled. The confidence usually doesn't come from arrogance. It comes from familiarity. In many Indian households, discipline is taught as the foundation of financial security. Save regularly. Avoid unnecessary debt. Buy insurance. Invest for the future. And if you follow these rules consistently, you start believing your financial system is solid. But hidden behind this confidence are several assumptions. We assume that if something goes wrong, our savings will be usable. We assume insurance will absorb large financial shocks. We assume investments can be accessed if needed. And we assume family support can fill temporary gaps. The problem is that these assumptions are rarely tested. Emergencies are unpredictable. Life moves smoothly for years. And because nothing challenges the system, weaknesses stay invisible. Until reality demands speed. Before the emergency happened, my financial setup looked perfectly reasonable. I had money spread across multiple places. Some savings in bank accounts. Some funds parked in fixed income instruments. And some investments meant for long-term goals. On paper, the total amount was more than enough to handle an unexpected expense. Insurance coverage also gave me confidence. Health insurance in particular felt like a strong safety layer. Premiums were paid. Policies were active. Documents were stored safely. From the outside, everything looked responsible. I believed my finances were protected because of four things. Savings were available. Insurance would handle major medical costs. Investments could act as backup if needed. And the absence of debt gave flexibility. But there was one thing I had never tested. Access. I had never seriously asked myself a simple question. How quickly can this money actually be used? The emergency itself wasn't dramatic. There were no headlines. No chaos. But it required immediate spending. Money was needed right away. Not next week. Not after approvals. Not after reimbursements. And that's when cracks began to appear. Some parts of the system worked. A portion of my savings was accessible. Banking systems were functioning normally. There was no complete cash crisis. But several things didn't work as smoothly as expected. Certain funds couldn't be accessed instantly. Insurance processes introduced delays. Costs had to be paid before claims were processed, and decisions had to be made without complete clarity. Nothing failed completely. But partial availability creates hesitation. When money access is uncertain, every decision becomes slower. You start asking yourself questions. Should I use this money now? Should I wait? Will I need this later? That hesitation revealed something important. Financial safety isn't about having money somewhere. It's about having the right money available at the right time. After that experience, I began asking myself a few uncomfortable questions. Could I transfer 50,000 rupees instantly at 2 in the morning if needed? Could I pay a large medical bill while waiting for an insurance reimbursement? If my phone stopped working right now, would I still have access to emergency funds? These questions exposed a weakness I had overlooked. Liquidity mismatch. My total savings looked healthy, but the money that could be accessed immediately was limited. Funds existed, but many of them were locked in systems designed for efficiency, not urgency, and emergencies demand speed. Under pressure, the brain starts suggesting shortcuts. I almost broke long-term investments that were never meant for emergencies. I considered borrowing money simply to buy time. I even thought about decisions that could have damaged future financial plans. Those reactions weren't irrational. They were emotional responses to unclear financial systems. This revealed something important about financial safety. Bad decisions rarely come from lack of knowledge. They come from stress. If your financial setup forces you to make difficult decisions during emergencies, then it isn't truly safe. After the situation passed, I made a few structural changes. Nothing dramatic, but very intentional. I stopped thinking about financial safety in terms of amounts and started thinking in terms of layers. Emergency money became separate from long-term investments. Access became more important than return. Insurance was treated as protection, not instant liquidity. And each financial layer had a clearly defined role. This shift completely changed how I think about financial safety. Because safety isn't about how much money exists in total. It's about how clearly your system responds when something unexpected happens. The biggest lesson from that experience was simple. Financial safety is revealed only when it is tested. Calm systems outperform perfect plans. And real peace of mind comes from structure, not assumptions. Financial safety isn't about predicting every emergency. It's about removing hesitation when life becomes unpredictable. Because when your system is clear, decisions become calm. And that is the real sign of financial security.